Hello, scholars. My name is Joseph AGK Oji. Welcome to my lecture series tonight. The topic of our discussion will be the collapse of the Silicon Valley Bank. First of all, let me share my page with you so I can see it on the screen. And then you can start. Okay, we can make sure we are seeing this. Good. Now, remember that the Silicon Valley Bank is the 16th largest lender in America, and it has an asset that is worth $200 billion. So naturally, it collapsed this week. It should be expected. The collapse sent shockwaves through the global markets. So a natural question to ask at this point is what really happened? What caused the Silicon Valley Bank to collapse? Well, the first thing you need to understand is this. Now, the collapse of the bank is, we consider it to be a classic example of the effect of asset liability mismatch. So when the asset and liability does not match, the kind of problem that will result from it, triggered by higher rates and compounded by leverage. So when the asset and liability of the company does not match, and then there are other problems like high rates of interest and high leverage, it can be a complete mess. So let's see what happened here at the Silicon Valley Bank. The bank actually, their main clients are tech startup companies, tech companies, and venture capital companies, in addition to the executive of these firms. So it is literally high net worth customers. So now, but the bank, remember, there is a competition in the industry. So to attract clients, the Silicon Valley Bank paid higher rates on deposits. So that means the higher rate, the amount they pay for the customer that deposit money at the bank is higher than what other banks paid because they want to attract customers. Now, to pay for this higher rate of deposits, the Silicon Valley Bank bought bonds, a lot of bonds. As a matter of fact, as much as 60% of their deposits were invested on fixed maturing bonds. So, but then that was before the Federal Reserve started to raise rates. So remember that because of high inflation that we experienced after COVID-19, stimulus payments, and of course, high gas prices, that, all these things caused the inflation rates and the consumer price index basically to go up. So the Federal Reserve is trying to, cut the inflation rate, to reduce the inflation rate. So to do that, one of the ways they do it is to raise the interest rate. That means increase the cost of borrowing. But the problem here is this. Remember, Silicon Valley Bank invested so much on bonds, and they used the proceeds for this bond to be able to pay for this higher rate of interest that they pay to their depositors. So they depend on those bonds a lot to meet up with those high interest rates. And they have significant amount of their deposits invested on those bonds. But the problem is this: bond prices, the value of bond tend to decline whenever the interest rate goes up. And I will show you what I mean by that with this example. I have this interest rate calculator that will help us to figure out. Now, suppose that this is the face value, the bond is $1,000, and the coupon rate is 10%, but the market interest rate is 1%. So this is a long-term maturing bond. Let's say that we use let's say, use a 4 years bond. That means the bond will mature in 4 years. Now, let us calculate the value of the bond. The answer will be placed on this section. Let me make sure you're seeing this. Yeah. So the answer will be placed on this section. So if I say at a rate of 1% interest rate, if you compute the bond price, that's the value of the bond, you see that it is 1,130. So $1,352.03. Let me use a 10,100 because this is a Silicon Valley Bank. Let me use 1 billion. So $1 billion worth of bonds, for example. Okay, calculate this. See, it is now worth this amount. I want to use a simple amount so that it will be clear to you what I'm trying to explain here. So I'm going to use $10,000 worth of bonds. So the interest rate is 1%. If you click, you see it is worth $13,520. Now, if the interest rate is raised to 3%, watch out, the value will go down. See, it went down to $12,620. So when you increase the interest rate, the bond price decline. If the interest rate went to 5%, for example, it went down to $11,792 approximately. Now, if I lower the interest rate to 1%, watch the value of the bond. It jumps to $13,550. So that will tell you the predicament that Silicon Valley Bank faced. First, the bond price, the value of the bond they have declined because of the Federal Reserve keep on raising the interest rate. So that means they don't have to be able to pay for the high rate of deposit, high rates they give to depositors. They have to liquidate those bonds. Okay, so that was what happened. So as the Fed raised rates, the Silicon Valley Bank started to take losses on their bond assets. So to complicate the situation, they kept a lower level of deposits at hand because remember, they invested 60% of their deposit on this bond. So they kept a lower deposit of them at hand and invested a greater percentage of this capital, on those bonds. So, in other words, they have been on a loose footing than other banks. Now, eventually, as they keep getting these losses, of course, they have to report by law. They have to make reports. They have to make their quarterly reports. Every quarter they have to present their financial statement to the investors, and their annual report. So they now made a statement, an announcement that they lost $1.8 billion in assets. This announcement was made only 4 days ago. 4 days ago. 4 days on Wednesday. So when they did that, the customers of the bank feel that, oh my God, they are losing money. They are losing money. So we're gonna, get our money out of this bank before the bank collapses. So that's what the announcement that they made caused. Remember, they made that announcement because they are required by law to report what is going on the company every quarter. So the bank failed to secure additional investment capital, and many customers rapidly withdrew their deposits. So they started withdrawing, something like a bank run. In fact, it's a bank run. So they can't meet up with the deposits, and then customers want their money anyway. And to keep on getting them, be able to meet up with those cash withdrawals, they have to liquidate more of these bonds. So the whole thing happened within 24 hours, just 24 hours. So it began on Wednesday, which is on March 8th of this 2023. And the bank surprised, like I said, they surprised the investors by that announcement of $1.8 billion asset sales, and they sold the assets worth of that amount, and they it's the CEO of the bank, as part of the announcement he made, they needed to raise at least $2.25 billion to be able to shore up their balance sheet, and of course meet up with the depositors' demand for withdrawals. So it was a big panic. People, like I said, people started to withdraw their money. By the end of Thursday, which is March 9th, the customers have withdrawn a staggering $42 billion of deposits. I don't see a bank that will survive that. It's really right. See a bank that will survive that. So the withdrawal continued. Like I said, it's like a bank run. It is basically a bank run. So to save the bank from immediate collapse, which will cause many customers to lose all their deposits and investment, the regulators closed the bank. So, and this closure make the bank to be the largest U.S. bank failure since the global financial crisis. So now, so what does there are a few things we need to know about this collapse. I mean, when I say that, I mean that there are more things we need to know. After the news broke, trading in the Silicon Valley Bank plunged, and then of course it affected the other banking. In fact, it affected the banking industry in general. The collapse. So U.S. stocks, most of the U.S. stocks, lost at least 1%. I mean, of their value by Friday. Remember, I said that this whole thing started on Wednesday, and within 48 hours, a panic induced by the very venture capitalist community that the Silicon Valley Bank had served and nurtured ended the bank's 40-year reign in that industry. So now, with the collapse of this bank, there's this adage we have in finance. It says that the Fed tightens until something breaks. And in this case, we can see what actually broke this time, which is the Silicon Valley Bank. So what does this collapse mean for depositors? Well, according to the California Department of Financial Protection and Innovation, who took, they took control of the bank deposits so that to, cut the losses. According to them, insured depositors will have the access to their money deposit by Monday of March 2023. But remember, in America, the Federal Deposit Insurance Corporation can insure customer deposits. Depositors' money up to $250,000. So those depositors with that kind of amount will get their money. But what will happen to big-time depositors, those that have billions of dollars there or millions of dollars deposited at Silicon Valley Bank? Nobody can tell as of now. We'll see. We'll be watching the developments now, of the coming weeks to see what is going to happen to those kind of depositors. So then what does this collapse mean for investors? Well, this collapse, of course, it is a huge hit to investors. I mean, those that invested in their stocks, we, of course, lick their wounds. And some regional bank stock prices were noticeably lower on Friday after the news broke of the Silicon Valley Bank's failure. And some of these bank stocks, some of those banks, their stock price, plummeted to as much as 20% or even more. But the good news is that the collapse of the Silicon Valley Bank is an isolated event. or at least it's a problem that may be limited to some smaller banks, So it's not like what we had in year 2007 and 2008, which means that that one is more basic. That one is systemic. All the banks are involved. They are high leveraged. They have toxic loans and so on and so forth. But this one is isolated to Silicon Valley Bank. So investors need not worry because this does not appear to be a situation that could become systemic, like the subprime mortgage collapse of 2007. So, in other words, the impact of this collapse on the financial sector and the broader market will be limited because it's an isolated event. Which means that I think, as a matter of fact, I will say this: the Silicon Valley Bank is the collapse is rapid. The bank also grew very rapidly, in a very specific niche industry, which is they give their customers mainly startups, companies, tech companies, venture capitalists. So they took a particular niche and they grow very fast. So unlike the other banking sector, other banks, and not only that, those banks like Bank of America, M&T banks, and then we have so there are many of them. Those banks, after the subprime crisis of 2007, they learned their lesson. So the broader banking system is regularly stress tested and has added meaningful liquidity and capital over the past decades. Not only that, they has worked to manage their balance sheets conservatively. So even though this thing happened, and of course, naturally, it is very natural for investors and the entire market to worry, it doesn't look like there's going to be a meaningful spillover into the broader banking system and the economy. So that's a good news. Then the lesson that we can gather from this collapse is this. Well, the collapse was caused by a run on the bank. And the bank could not meet up with it. This run, they could not survive it because they have a lot of their assets invested in in the bonds. And those bonds that they use it to pay for the high rates of interest they pay to the depositors. Now, with the increase in the rates, the bonds lost value, so they couldn't meet up. So that what happened to the Silicon Valley Bank is unique and surprising. It doesn't mean that the bank wasn't insolvent. It wasn't even near to be insolvent at all, at least before the client started to rush for the exit. But its collapse is a proof that bonds lose value when interest rise. So when Silicon Valley Bank customers, who are mainly startup firms that often bond through cash, they bond through massive cash because they are startup firm. So their customers, when they start to make huge withdrawals, the bank could not meet up and had to sell the bonds at a huge loss. So the bottom line is this: banking is an enterprise that is relying so much on confidence as on cash. And if those two things run out, confidence and cash, the game is over. So this is what happened to Silicon Valley Bank when they made that announcement. Cash and confidence, run out of the window. And when they make that announcement, they literally struck themselves on the heart. So for all finance professionals and for my financial students, always have this in the back of your mind. Good cash flow management is the key for running a bank and for any business for that matter. So this ends our lecture for tonight, and I hope you enjoyed it. Thank you for listening, and I will see you in my next lecture. Good night.